Welcome to the Gray Report. I'm your host, Spencer Gray. If you're a multifamily investor, passive, active, you're just interested in real estate investing, maybe you're actually working in a multifamily property, you're working in the multifamily industry. The Gray Report is the one YouTube show and podcast that really is designed for you to keep you up to date with all of the latest information, research reports, all the new data that's coming out, articles, as well as just, Matt and I giving you our opinion about what's going on. So kind of strap in. We've got a lot of great reports. Marcus and Millichap, see what else, CBRE, Fannie Mae, the NAHB, Redfin, all kinds of good stuff. And again, you could spend hours every single week trying to search for all this stuff. We're doing the hard work for you, aggregating it all, breaking it down. So make sure you subscribe to the Great Capital YouTube channel. You're subscribed to the podcast. You're following us wherever you need to. Stay up to date. All right, let's get into it. All right, bringing it all back in. Matt Bosnagel, Director of Communications and Marketing here at Great Capital. I'm in the Great Capital headquarters in Indianapolis, Indiana. Matt is recovering from just the dark depths of COVID. Matt, how are you feeling, man?
I'm definitely feeling a lot better than I was yesterday and the day before, and I don't think a relapse is coming. So
okay, that's good. I'm glad you're feeling better. But a lot of really good reports, a lot to go through. Every week, something has changed in the commercial real estate market, as it has been the past couple of years. But it's kind of the winds are blowing the other direction, and so the ground's moving quick. Want to figure out what's going on. I think one good way to start, Matt, is looking at the CBRE 20-year outlook.
Okay, yeah.
Sorry, the Marcus and Millichap, the 20-year outlook. Because a lot of times some folks are getting into real estate for kind of the quick flip, get in and out, get in and out. And we can just be so focused, as we often are here on the Gray Report, of what's the latest, high frequency data, what's going on with what's the unemployment rate today, what are jobless claims, what are the interest rates today, which is important to know when you're in the middle of transactions, you've got deals going, but it's a lot of noise.
Yeah.
And it can be hard to see the forest through the trees and to look at, okay, what's the next 5, 10, 15, 20 years going to look like? Because for most investors, again, not all, but for most investors, investments into commercial real estate are long-term endeavors. They're not short-term flips. There's nothing wrong with doing something short-term, but most of these are long-term projects and business plans, not usually 20 years off. I think the average hold period is around like 4.5 or 5 years.
Yeah.
But having that vision is important.
Well, and I think a lot of times it can scare people off if you can't get out quick. If you got everything locked up for 5 years, I don't want to give up that control. But I think sometimes I'd argue that that's good. That's a good thing. You don't want to be jerking around the whole time and reacting to every single thing.
Yeah, I know a lot of investors who say, look, I like the illiquidity because I can't just like panic sell or something. It's in there, it's locked up. I don't have to think about it other than just, I get my distributions, I get my reports, and I if I had that cash sitting there, I'd spend it. I'm not sure what I would do. If it was in the stock market, I'd just be trading it. And I want something that's much more steady. And it's not that we're necessarily going to we're going to hold a property for 20 years because, cycling through is a good way to increase your returns. But it's more of where you want to be allocated over for the long period of time, assuming you're going to be kind of cycling in and out of projects, but looking at your overall portfolio, what sectors, what asset classes do you want to be in, and looking at a long-term time horizon, because a lot of people, when they're thinking about whether it's retiring or building up that nest egg, it's the next year, 5 years is important, but let's look at 20 years. What that's going to look like. I think a lot of people would say, maybe I'll be slowing down from working in 20 years, or at least have the option to do so. I love what I do, but I want to have some. Yeah, I want to be a choice rather than I have to keep working. So that's what I really appreciated about this. Now it's a video. We're kind of play the video while we discuss a little bit. But the conclusion that John Chang from Marcus and Millichap makes, right, so we're going to be looking at a video from Marcus and Millichap, John Chang, who really leads up a lot of their research and their a lot of their content creation, thought leadership. He's a really smart guy based out of Phoenix, um, and they talk about a lot of what we just spoke about, Matt, of trying to filter through the noise and not looking at necessarily as for high frequency information, but looking at the prospects over the long term. And what they did was look at the past 20 years to give us maybe an idea of the next 20 years, but then kind of baking in the different demographic trends and opportunities to kind of understand where some of those opportunities might lie and just what is good to keep in mind. And I'm just going to fast forward the video, and you can find this video. I mean, if you're subscribed to the the Gray Report newsletter, you got this video sent to you this morning. But you can find it on grayreport.com. And I just want to fast forward, really just looking at 20 years, really from 2001 to 2021, where we have most of the data. We can look at some of the price trends, seeing basically a decline between '07 and '09. And then looking at some of those rent trends, see that quite a slight decline over that period. It was averaging a little under 900. It peaked in about 2007 over 950, dipped down to basically 950, and then just look at a straight trajectory over the next decade, and then COVID, a huge parabolic leap up. And same with price trends. They obviously are linked to each other. This is the average price per unit. It's not surprisingly kind of linked to that average rent price. And we saw a decline, in the Great Recession, but then we've been just on a meteoric rise ever since then. And so, his point is that you could have invested in at the peak. And right now he's looking at what the S&P 500 did, but you could have invested in at the peak back in 2006,
Yeah.
2007, and you would have made incredible returns if only if you had a long-term time horizon. If you had a short-term time horizon, you could be caught up in trying to catch a falling knife and sell at the wrong time. I just want to watch this graph. So this S&P 500 since 2001 has returned 416%. Apartments, though, have returned 458%, not including the tax benefits. Now, retail is just about the same, 461%, which I think is a little bit surprising. Because retail, I think there's a little bit higher
Yeah.
risk there. But retail is done pretty well. Industrial, though, is really kind of the darling. It was really on the same track as multifamily up until about 2016, 2017. But then it just started accelerating. A lot of that is due to the boom in e-commerce and logistics, and has not been slowing down by any means. So it really went parabolic during the pandemic, and is the top performer, delivering an 848% return since 2001. Now, office was the one laggard that it was kind of tracking the rest of CRE, but then it's really kind of taken a hit in the pandemic. Now, it hasn't really dropped significantly,
Yeah.
but you basically have a very similar return, or a little bit less return compared to S&P 500, 341% return for office properties compared to a 416% return to the S&P 500. So I think that's a pretty good return, and pretty much all CRE asset classes outperform the stock market besides office. And what this doesn't bake in is all the tax benefits that commercial real estate offers as well, that really can be a driver that's hard to bake into that overall price.
Yeah. I think one of the things that it's like, this is just, yes, it's just a video, but it's also worth watching. And sometimes I get as much from a short video as I do from like a lengthy report. And this one really captured a lot of what I was feeling. I think his refrain was "keep your eyes on the horizon." He said he'd been saying that since the beginning of the pandemic, and it's true today as it was, in March of 2020. I think that being said, I think that what keeping your eyes on the horizon allows you to do is actually pay attention to the correct thing, not necessarily only pay attention to 20 years from now, but pay attention to the things that will be impactful in 5, 10, 15, whatever years.
Yep.
So like, for instance, interest rate increases. I think that that might be one of those levers that will really disproportionately impact things down
Mm.
the road.
I mean, they will and they will. I mean, I don't know. Maybe I disagree. I mean, I think I think that's short term, 100%. I think in the long term, I think that's the noise. I
Yeah.
think that's a lot of the you have to pay attention to on making transactional decisions. But a growth, looking at where growth is and all the other factors that are much more long term, I think overweigh even interest rates. I think you can make short term decisions that put you in a bad spot right now with interest rates. Um, but I think like so the next piece that he gets into is really the demographic shifts of millennials. Millennials are entering their peak home buying years, and this I think it's really interesting. He really compares it to when the baby boomers were entering a similar point in their lifespan. So he looks at housing values between 1983 and 2021 as a kind of a similar period in time, and just looking at the inflation adjusted return um, of just single family homes and single family home price trends. Here, let me go. So, baby boomers are growing older. So, they're age 87. They're going to be needing these senior housing facilities. And so he's really saying senior housing and medical office demand is going to continue to increase. And I think those are two good sectors. There was some overbuilding in the senior housing space in anticipation of they call it the silver tsunami, all these baby boomers that are aging out. But again, by 2042 is kind of the date that he's marking as we're going to see a real increase in demand for senior living and medical office facilities. There's also this massive wealth transfer. It's the largest transfer of wealth in, I believe, in history. So 84 trillion with a T, a big capital T. 84 trillion dollars is going to be transferred from the baby boomer generation to older millennial children. So that's a lot of money. Millennials are going to are going to see potentially, and we're going to see some interesting effects when that take place. And I think that's already started to occur, just at a much slower pace.
I think that one of the things that we have been saying for so long is that there are these generational trends that are butting up against housing demand, and you hear all this stuff about a housing bubble, and and like, is it coming? And it's hard to picture a housing bubble. This kind of again, keep your eyes on the horizon. It's hard to picture a temporary housing bubble doing any kind of impact on the millions of people that are going to be forming households, on the amount of money that's going to be transferred from one generation to another, on these huge, decades long forces that are pushing up against it and really kind of peaking in the next 5 years. And that's
Yeah.
what I thought was really one of the most interesting things is like, we really are maybe at the peak of this moment, like right now.
Yeah. I think it'll be interesting. Yeah, because we're seeing record high prices, and maybe we'll see some demand destruction because of that. But I think to what you were saying, Matt, is that there's just there are some forces so powerful that could overcome that, and it's good to have a watchful eye for. But how many people who have taken a pause in the housing market doesn't mean they're never going to buy a house or they don't want to buy a house.
Yeah.
It's that like, okay, maybe not right now is the right time, but if prices do see any kind of softening, there's a long line of folks who are ready to line up. And if we do see a recession, which we're gonna get to here just a little bit about talking about soft landing or not, and if the prices come down, there's a long line of people ready to go, and interest rates in that recession will decrease and will allow for an attractive buying period. But even with the higher interest rates, it's just a shock right now. But the higher cost of capital is all relative to the amount of growth and the rate of growth. And so people were buying houses, back in the 80s when they had that chart of prices continuing to rise. Interest rates are 10 to 18%, and people were buying houses and thinking they got a good deal. And it's because the growth was carrying them through. And the big question right now, though, is are we going to continue to see that continued growth? And it's really for for how long. So it'll be an interesting couple of quarters as that kind of shakes out and see where it all goes.
Yeah, and I would argue that this moment will be extended only because it's so difficult to create new supply as well.
Yeah, that's a really good point. I mean, yeah, there's some markets where there's just no. I mean, we were up in Lansing, Michigan, um, the past couple days, doing due diligence on a pending acquisition we have up there, and was talking to a real estate investor in the market who we were touring one of his properties. He said there's a couple corporation, big companies that are moving into Lansing. They made some announcements. They're like, we're going to bring like 300 employees in like now, and they looked at the housing market, and there are 150 houses on the market in the area for 300 of their employees.
Yeah.
And it's not as though those 150 houses are even all they even want to buy any of those 150 houses. So like maybe a third are appropriate in the locations. So maybe there's 50 for the 300. And then there's a whole other market of everyone else who wants to buy a house. And
Yeah.
these are high paying jobs of people who are like, they just need to find somewhere to live. The result of this is what we're seeing is increased demand for apartments because
Yep.
everyone who is looking to buy a house all of a sudden is like, I'm going to wait just until I understand the market, and maybe I'm going to rent for another year or two.
And that's what I think is the benefit of apartments. It kind of has a little bit of both ways. If there's high housing demand, there's going to be high apartment demand. But if things happen and houses, maybe there's a housing crash or some apartments are still kind of insulated a little bit. And there's always going to be that demand there, whether it's coming up from people that are planning on buying a house or whether it's people that are staying off and remaining renters because they simply can't afford a home. There seems to be a place for apartments in any of those kind of paradigms.
Yeah. And I think that's why it's important to have kind of a diversified portfolio of not all C class, not all B class, not all A class, because, different kind of income levels are going to perform differently in different parts of the economic cycle. And you're going to have some wages and incomes lag and some that are accelerating, and then some are going to catch up, and different economic time periods, hit different sectors in a different way. And as people kind of move up and down through the economic ladder, the people who are living in C class properties, and they move up to the B move up to the A, but then the A class apartments maybe get too expensive and a recession hits, so you move down from the A to the B. People sell their homes, they move into the A class or the B plus class. So you get all this moving around. Now, it like we've said a million times, Matt, recessions aren't good for everybody because it's economic disruption, and there's evictions, and you get more volatility and more higher vacancy just because you just have people moving out more. So it's not good, but it's more in the margins than many other industries, I'd say.
Yeah, that kind of gets into our next source for sure.
I think so. So CBRE, inverted yield curve, doesn't always signal trouble for commercial real estate values. Matt, kind of bring us in. What is CBRE? This is timely analysis.
If you scroll down to the chart that they have, or the graph rather, it really kind of illustrates it a little bit. Their argument is that it doesn't always signal trouble for commercial real estate values. And yeah, that's true. But the way that I'm looking at it, it doesn't look great. And it almost looks like a wash. And a wash where you're getting zero value increase over time is either a money losing proposition. If this graph isn't inflation adjusted, couldn't really find that in the notes there. Or it's a bad investment compared to the many low risk alternatives that would give you higher returns over the 16-month period measured in this brief. I would be really interested in some analysis of how different sectors perform in the wake of a yield curve inversion. Intuitively, I feel like if there's less consumer demand, you'd think that retail and retail demand would be reduced. Industrial could be affected as well, alongside hospitality if people are spending less. But housing may not see as direct an effect from recession, and may instead kind of see an indirect impact. Apartment demand will likely remain high, is my guess, even as retail, hospitality, etc. goes down. But due to people having less money, rent growth may slow down.
Yeah, slow down, or it often you'll go either flat or negative for about a year or so. I think it's important to relate one asset class versus the other, and that apartments don't accelerate during a recession, but they don't necessarily have the swings that maybe other asset classes you might see. And so, your cash flow, if you were doing 8%, maybe it goes down to 6%, or 5%. Well, you're still positive for the year. And then the illiquidity, I'm sure. I mean, if you were doing a mark to market every single day, you may see a value change. But unless you have to sell, you have to pursue a capital event. It sort of doesn't matter, because you can hold through.
Yeah.
I mean, again, in the pandemic, there was a period if that there was mark to market of just sediment of what all the values were. Yeah, everything would have decreased in value, but no one sold then, so that never happened. There's no price discovery, so that just didn't exist. Outside of the public REITs where that was priced in, that's one of the disadvantages of being in a REIT versus being in private real estate. And it's so similar case. If the market's not good and if you've positioned to sell, your kind of mark to market value does not really matter, and you can really wait it out and you get the value that makes sense. But you have to have the liberty of time to be able to take advantage of that.
Yeah, I think that there are important events, and this almost seemed a little bit like a "Don't worry, be happy" kind of article. Like, hey, this
Well,
year,
they're trying to slang some real estate and debt. So
yeah, and but I think that there's other ways. More important is like you have, again, like I said, if you have your eyes on the horizon, you'll know the major events when they come. And this, a recession, it seems to be like a major event, and it may be time not to think about buying more or buying differently or selling or anything, but rather kind of seeing where the opportunities are and making different decisions, and and kind of taking stock of things a little bit differently rather than having blind faith, basically.
yeah, yeah. Absolutely. Yeah, you don't want to just keep doing the same thing the way you've been doing it, just because that's what you've been doing. That's never good.
And on the other hand, I keep hearing stories of labor shortages and market rallies, and, but it's like there's still this dissonance, and I know it's because we read up on stuff, and we we're kind of trying to keep our ear on the ground and listen to what all the economists say, that they're expecting a recession, but there seems to be like we'll know right now an inflection point that's beginning to happen where maybe things are beginning to turn, and that's where I think it pays to be extra astute at certain moments, and I think now is one of them.
Yeah. I think it's definitely time to be cautious and aware and observe what's going on. We also have to kind of square that with anytime that there's everything doesn't look rosy, everyone immediately goes to recession talk and in
Mhm.
worst case scenarios. And there's like a war in Europe. There's all this stuff going on that just leads to cloudiness and uncertainty. So people go to it's recession. It's all going to crash. I mean, we could every day for the past decade or so, someone's been calling for recession and a market crash. um Most recently, I mean, well, throughout the pandemic, I mean, people have been calling
Yeah.
for a housing crash throughout. But even prior to that, in 2019, I mean, there was this, I forget the one source, but it kept popping up my Google news feed literally every single morning. They would have a new art. It was like their cottage industry in their niche of like writing about housing crashes. This is in 2019. And interestingly, they kind of just, I haven't seen anything from them, because they were just like flat out wrong and just didn't understand. It was clickbait because if people want to read about crashes, that doesn't
Well,
mean that there's not turbulence.
and
But
and here's the thing too, is I keep thinking about this. It's like there was a brief, I don't know if it was technically a recession, but there was definitely a downturn in 2020,
yeah,
and there were some moments in the multifamily market where people were not getting rid of, but they were selling their properties for much lower values than they would have gotten had they held on to them. And this, it just pays to pay attention and to really see, okay, what's the long-term effects of this going to be, and could I find a deal here, or
yeah.
yeah. So
Well, I didn't see anybody really selling at like lower. Like they were, I knew some people who were like in 2020 who were like already going to sell right before the pandemic, and those transactions went through, but they just got like kicked off to the end of 2020. But I didn't see a lot of people like bring new stuff to. There was like a pause in the market,
yeah,
and didn't really see like anyone like fire sailing, but everyone was waiting for that. And
yeah,
and a lot of what you saw was a lot of people kind of waiting out the market. And I remember this because everyone's like, I'm waiting for that COVID discount, waiting for the
Ooh,
COVID discount, waiting for that pandemic discount. And I'm like, yeah, well, let me know when you start seeing it. I'm not seeing it. And the discount, was that we were getting ready to see an incredible amount of growth, and the discount was there. It wasn't a discount based on 2019 pricing. It was discounted on the future growth.
Yeah.
And if you saw, which is what I think we saw and gave us the confidence of, the floor not falling out underneath us. Occupancy was staying strong, largely attributed to government stimulus and stimulus checks, and people, just no one evicting anybody. Although that it wasn't helpful in the long run. But occupancies tightened and housing demand shut up. I mean, no one predicted. I mean, no
Yeah.
one predicted housing demand. Then everyone was moving out to the suburbs and moving everywhere, and that increased the velocity and moving in, moving out, increased rents. And so the big discount was to get in while prices were still flat or low compared to the future. We made a handful of transactions in 2020, Matt, that you were a part of that, where everyone else was just sitting on the sidelines, and they're like, "Nah,
Yeah,
we're not
sorry.
doing anything
I'll
right now."
correct myself. People weren't throwing their assets away or anything like that, and they weren't scared, but there was definitely a different read on the situation
Oh,
than what we
100%.
had, and it allowed us to really, I think, find some great opportunities that year.
Yeah, I mean, I'll keep knocking on the wood about villas all day of the week. It was, one of the best buys of my career, and it was only because of the fear and uncertainty in the market, but then filtering through the noise and saying like, well, we're looking at the data, and look how much, and just looking at future inflation. I mean,
Yeah,
we were seeing the future inflation of just saying, like, I don't see how you can create this much money and spend this much money, and you don't create an incredible amount of inflation, which leads to it's an inflation of assets. That's what happens.
yeah.
Asset prices increase, whether it's the stock market and real estate, and that is 100% what we saw. So, but let's just again, caution. Let's just make sure that we're looking at things the right way, because there's definitely some storm clouds on the horizon.
Mhm.
So Fannie Mae, they're definitely they put out relatively conservative pieces, do a lot of lending. Our good old government sponsored entity, um, economic growth forecast downgraded as soft landing appears increasingly unlikely. A higher mortgage rate environment expected to slow housing activity. Matt,
Yeah,
what's your
I
take
think
on
the
Fannie Mae's take?
subheading, I think the subheading it would probably be more accurate given the purview of Fannie Mae, but that's fine. I guess they can take on whatever they want. I think the key quote here, at least for me, is the following. It says, data from U.S. economic history suggests that successfully negotiating a soft landing requires monetary tightening to be preemptive rather than responsive. As such, we've updated our 2023 forecast to include a modest recession, but one we do not expect to be similar in magnitude or duration to the recession of 2008. I would like to know whether how this would compare with like I said, that kind of flash recession of 2020, and also how what maybe the projections for recovery will be, because if this is due to the Fed rather than this kind of exogenous event of the pandemic, what will that do? Is the demand going to be there? And my big question too is all of this great news of the economy and this recovery. Is the current great news, is that going to mean that our economy is going to be healthy enough to recover quickly from an upcoming recession, or is that just the seeds of a burgeoning implosion?
Mm.
So yeah,
Yeah, the good thing is I think we've got a lot of headroom built in, for the recession to be not as painful as we think. Now, who knows what's kind of creeping under the surface, and what the black swans and kind of the financial shenanigans. I mean, that
yeah,
were going on in 2006, 2007, to run up to that recession. But I think you're right, Matt. I think it's going to be a more flash in the pan technical recession, because interest rates, if growth slows down organically, which that's a question of how much that is happening or not, with then just interest rates also decreasing growth all at the same time, could put us into a technical recession. But unemployment rates are like all-time lows, so we've got a lot of room for to move. We're not going to see that that crazy spike in the job losses, the job losses claims that popped up to like millions in a single month. I don't think we're going to see that. People have more savings than they ever had. Equity in homes, I mean, like, prices could values could decrease 30% and people still probably wouldn't be underwater.
Mhm.
And people have there's a lot less floating rate home mortgages.
That's what
Fannie,
I
yeah,
that's what I'm really what I'm really hoping is that, I keep thinking back to, and both of us kind of came of age during the Great Recession,
yeah,
and I'm hoping that the average economic decisions of the individual and corporations alike are guided by these worries and anxieties of not repeating what happened in 2008, and how that kind of extended over, man, nearly 10 years. It seems like the government policymakers really made sure that the pandemic crash was quicker or softer or barely felt. But I'm hoping that the economy as a whole has been kind of chastened by the bad decisions that were made in the you know
yeah. No, the lending standards got much, much better. And so we, again, like we don't have everyone on, adjustable rate mortgages that are all on teaser rates that are going to flip all of a sudden while interest rates are going up. So just like people have to sell. Fortunate people have financed their homes in a way that they don't have to do anything. They can just hold on and they can be fine. And they've locked in these really low payments and interest rates. So I think most are going to be relatively fine. I don't think it's going to be as much in the housing market. I think it's maybe a little correction that maybe that would be healthy. One thing
Yeah.
that I'm
Oh,
yeah,
sorry.
yeah, well, one thing I'm just curious about, just talking about the Fed, and it's all lessons learned, and they're always looking at they're kind of fighting the last war, but looking at new ways to do it.
Hmm.
One lesson that they learned, after what the Fed did in 2008 is, they provided a lot of stimulus, but they didn't maybe go as far as they thought that they should have gone. And they didn't see that much inflation. Everyone was worried about the inflation because of quantitative easing and printing
Yeah.
of money and spending money, and we really didn't see that. We really saw, very flat inflation, sub 2% over the next decade. Um, and I think that gave them the confidence to say, no, well, we need to save this economy all out. Let's lower the rates to basically
Yeah.
zero, spend a lot of money, just pump it, pump it, pump it. And it did get us through, and there wasn't a major crash. But the result is what we're all living with, the $20 cheeseburgers or, whatever, and
Hmm.
it is inflation. And so they're not immune to causing inflation, as they shouldn't have ever felt, but I think they were kind of curious. Maybe they could get away with it. And so if what that effect has on their next policy moves, if they say, look, this worked the last time, we got everybody through, we had to deal with a little bit of inflation, or they're going to say, okay, it worked, but we really have to tamper. We can't just spend as much money. We can't just print. We can't just quantify, do quantitative easing and buying up mortgage-backed securities, because we created this huge housing bubble. Like they're like, we created this huge housing bubble because we created so much liquidity in the MBS space, because we looked at the last time when that was needed and we didn't do enough, but it wasn't even really needed this time because the problem wasn't in the housing market, and there was all this housing demand. And so how they're going to react is going to be interesting, to say the least.
Yeah. Yeah. So and I think that the impact on the housing market, specifically what's happening right now, was one of the more relevant parts of the Fannie Mae report here. And they say that in particular they expect house growth to decelerate to a pace more consistent with income growth and interest rates. They say that households with a 3% 30-year fixed rate mortgage are unlikely to give that up in favor of a mortgage closer to 5%. And so this lock-in effect may weigh on home sales. And they say if mortgage rates remain relatively elevated, we expect the added affordability constraint to price out some would-be first-time homebuyers and contribute to the slowing of demand. So kind of to review my comments from the earlier article, CRE valuations after a yield curve inversion may suffer from reduced growth, but certain sectors, I argued, may be more sensitive to the reduction of demand than others. Housing, I argue, will be more insulated from this reduction of demand because it's a core need. And there's a space there's already this kind of waiting pool of people that need housing that from the single family home market that they may be priced out of. And this is the example right here that Fannie Mae gives people
Yeah.
that priced out.
Yeah, where are they going to go? I mean, the only, I guess it's not really a counter, but just another point is, some people, point to in economic downturns, you'll have households will decrease because people will like, move in with roommates and they'll move in with family. But then you've got a lot of this in terms of just rentals and multifamily. You've got people who are moving. Okay, they're not going to buy a house, but they're going to be renting.
I had a bullet point. My following bullet point.
Okay, get into your following. I'm not reading your notes.
Unless all of these people are priced out of their homes, choose to live with their extended families, or become roommates with each other, that's going to keep multifamily.
There you go. Boom. We're on the same page. We're on the same page, Matt. Okay, let's look at this piece from Redfin. Rental market tracker, asking rents climb 17% to a record high in March 2022. Wow, Matt.
Yeah, so we've gone through this Redfin report before, and I called attention to the fact that it allows you to measure the mortgage rate, the price of a mortgage monthly average versus the average rent for Americans. Mm-hmm. And the broader story is the same as it was last month. The average cost of the monthly mortgage has risen more than the average cost of monthly rent. But it is insane how much the gap between the two has shrunk. Mm-hmm. Right now, and these numbers come from Redfin, obviously, rents are only $30 more than mortgages. So it costs the average rent, as measured by Redfin, $19.40 to $19.10. Pre-pandemic and really up into January of this year, that gap was 10 times larger than it is currently. Now, the Federal Reserve's inflation hawking, I don't know if that's a word, but their interest rate raises is a big part of this drastic change on the interest rate side. And I'm sure that the competitive single-family home market is a factor on the price side. But what I'm really interested in is how this razor-thin gap, how is that going to return to historical norms? Is this going to mean that average mortgage costs slow down due to a cooling single-family home market? Or will apartment rents go up in response to rising home prices and increased demand from would-be home buyers? I mean, obviously it's going to be something in between, but I'd much rather see a situation, and I think everyone would where apartment demand is high and that people are able to pay for rising rents, rather than a situation where the price of a home has gone down and rents are stagnating because there's just less money to spend.
Yeah. It's what else, people can only be squeezed so much. And so,
Yeah.
Are we going to see a decrease because we got to have a place to live? And maybe this does force some people to move in with be roommates or, with whoever, because it's like, it's all unaffordable because renting should be more expensive than your mortgage payment.
Yeah.
Because it's a short term, you're getting a premium for, like, you get a place to live for a year. You don't have to make a long-term commitment. You're also not responsible for everything that breaks.
Yeah.
I mean, you own a home. Yeah, you're paying the same, but man, whether it's a hot water heater, it's your roof, it's sidewalk, you got to tear up your front lawn because of some issue with the city and the sewer. You could be out tens of thousands of dollars easy when you own a home. And when you're renting, that you don't have that risk. So to see that they're like the same. There's no, what's the advantage of
$30? Is it worth $30? I was just doing the math just now.
Yeah,
that's like 1.5% difference.
And that's what I think what we've been talking about, and what you were just suggesting is just going to say people are going to say, I'm going to hold off here. I'm going to hold off, and rent and see where things go, and maybe I'll get a discount in housing at some point, and because maybe prices will go down and I can get in, and maybe that balance changes. I think there's still a huge demand and urge from millennials who are at home buying age and starting families to buy a house. I think what this is we're already seeing it. We're already seeing a lot of our properties, but as an increased demand for larger units, Class A units. People still want to live in a nice place. And so I think a lot of kind of that B to A plus those assets are going to do, really very quite well, over this period. People want to live in a nice place. I saw a funny short, Matt. This guy, it was like a 15-second song, and he was saying, have chain restaurants, has the quality in chain restaurants gone down since when we were growing up, or have we just all gotten a little bit more bougie?
Yeah.
Or is it both?
Well, and I think I think certainly for apartments, they've been wanting more. That's another thing that tracks through the pandemic is that not only has housing demand, has apartment demand gone up for across A, B, and C class apartments, but people have wanted nicer apartments, bigger apartments. They want the home office where they can, put on their Zoom meetings, and so they want and need more. And there's some stickiness, I think, to some of those trends that have happened there too. Yeah.
Which is a kind of a misallocation because in the last 10, 15 years, the trend was, 1s and 2 bedrooms. No, like I remember like the 3 bedrooms aren't where you want to be because those people are buying houses. You just don't want, each 1 and 2 bedrooms is where you want to be. Studios, maximizing your price per square foot because you can get a higher price per square foot on on smaller units. But it's hard to do that if the demand's not there. You can actually get a premium on the large units because if you look at a market, there's aren't that many 3-bedroom units out there compared to 1s and 2s. And so there's only a handful of those 3 bedrooms. Those get sought after, and those rents, I mean, we're just seeing in some of our properties with 3 bedrooms. I mean, they're commanding an incredible, incredible premium, especially ones that have, really large space, whether it's a den, especially if it's got a garage. The amenities that make it really feel like a home rather than an apartment are going to stay in demand for the foreseeable future. Yeah, so it'll be interesting.
I really wish that this chart went back a little bit farther than 2019, but it's hard to see such a small gap when everything else is so big, and I feel like something's got to give.
Yeah.
There's just too much drama in that line graph for me to.
And that's what you and I have kind of been saying, right? That rents have gone up a lot. I mean, here's this article right underneath. Asking rents in Portland are up 40%. It's in Austin, it's up 38%. Tri-City area, many parts of Florida, so rental increases of 30% or more. Top 10 metros with fastest rising rents. I mean, it's crazy. And so people see that. Surprising, Kansas City has declined, but people see that and they're like, well, rents can't go up. That's crazy. But look at the prices of everything else, literally everything else.
Yeah.
And they are up way more than what rents have gone up. And housing, as sticky as housing is, people need a place to live. And it's relatively more affordable buying a home. And if the big question is wages, as we've said, it's either wages, and then getting back to our point earlier, okay, well, maybe you can't afford that Class A, paying $1,600 a month, $2,000 a month. So maybe you're going down to Class B. You're getting a still, nice quality asset, but you can get the value, maybe just moving down in quality, and there are options, and you have to move somewhere. And so it's maybe a reshuffling, but then you get the people who aren't buying a home who can still afford the Class A. And so again, it's just this shuffling around of, people are finding a way to pay, but still want to watch wage growth because that's certainly the limiter on rent growth. And there's no reason no one wants to squeeze everybody, but it's really just it's all relative to the price of all goods and all commodities and prices of everything. You just can't look at it in a vacuum.
Yeah, so I'm going to dig into this more. This is a promise. I'm going to try and figure out what the median mortgage, how that compares with the median asking rent in previous months. I want to look into how it was in like 2018, near the when the Fed last kind of raised rates or changed their policy a little bit, and see if that brought things up temporarily. Because I feel like, at least this is my intuition, is that for as rapid of a rise as we've seen since the beginning of this year, it could maybe that gap could return to normalcy, but.
Yeah. We'll see. And just Matt, let's ending on that note. I just want to look and share again one last time. Let's look at that 10-year treasury, because again, that's what a lot of the fixed rate debt is based on. That's what mortgages, 30-year mortgages are based on. We saw this period here in, the 70s and the early 80s of incredibly high interest rates, with the 10-year treasury, peaking here at 15.84%. Back in 1981. We've been on a steady decline. Now, if we could back this out even further, you've seen that the steady decline has been going on for quite a while, as just markets have become more efficient, capital markets specifically. But then we had all these issues in the 70s and 80s. But here we are. Here we are in April of 2022. 10-year it hit 2.9% on Tuesday, which is incredible. It's the highest it's been since kind of this 2018 period. But really, so we're really going back to kind of 2008 rates, or we saw similar rates in 2013. Similar, at 2013 we had 3% 10-year Treasury rates. Back before the recession, and 10-year Treasury was at 5%. Now the big difference is in multifamily specifically is the cap rates are so much lower.
Yeah.
So yeah, you could be buying there's a 3% on the 10-year, but your cap rate was 6%, maybe 5.5%, 6% in 2018, as opposed to 4 to 5%. So that's a big difference there. The other big difference, though, that counteracts that is the growth, and that's where I think it's more important. The most important thing to watch is this continued growth, because the interest rates can be kind of whatever they are. But if they're relative to growth, you can kind of grow out of that.
Keep your eyes on the horizon.
Exactly. Keep your eyes on the horizon. Cap rates, you can grow out of your cap rate. If growth stops, that's where you get in trouble. You can't over speculate, but if you have some insight into where growth is today, I think you can start to make sense of this. And that's what we're seeing. Some markets that are seeing some incredible growth have a lot of growth that they have just so much runway still to go.
Yeah.
And so there's still opportunities out there. It's understanding where that rent is growing to parse the true opportunities to where you can get in trouble, and then just tweaking our strategy and the tactics we're using to finance these assets so we don't get tripped up in the near term.
Yeah, for sure.
Yeah. All right, Matt. Great report today. Again, you can find all this stuff. Be subscribed. Give a comment. Let us know what you think about this episode. If you give a good comment, we will discuss it on the next episode of the Gray Report. Make sure you're subscribed to the Gray Report newsletter. You can do that at graycapitalllc.com/Gray Report. Go on over to grayreport.com, though, to get all this information updated every single day. And if you're an accredited investor, as it's only open to accredited investors, and you want to kind of participate in the strategy that we're pursuing, great assets, long-term holds, all that good stuff. Where is it? Oh. Shoot us an email. Learn more about the Gray Fund. You can go to gray.fund. You can download the deck. You can shoot me an email. Spencer at graycapitalllc.com. You can email Matt at graycapitalllc.com. Not only will we send over one of these fancy books giving you all information about kind of Gray Capital, the Gray Fund, all kinds of pro formas, information, great pictures. It's really well done. It looks great, Matt. You did a great job putting this together. We'll send you some swag as well. We've got a lot of good options.
Nice. I'm excited.
Not just water bottles. I mean, this is kind of like the iceberg, tip of the iceberg. We've got basketball hoops. We've got T-shirts. And again, we're not trying to be gimmicky, but it's fun. We got some quality gear, and we want to send that gear to folks that appreciate
that water bottle is fully insulated, by the way.
Yeah, this is a good find. This is a good find. You can see it's good thickness there.
Insulate your drink from risk, right?
Exactly. It's all about trying to hedge those risks. So hit us up, just shoot us an email, send us a message, say, send me the deck, send me some swag. We will do that. That's why we mentioned at the end of the video, because we want to reward the folks who watched this whole video, learn something. We say, let's hook up our best subscribers, viewers, and listeners with some cool Gray Capital stuff. So Matt, any closing remarks after whatever I just did?
No. I'm speechless, in a good way.
Now, if you're listening to the podcast, you didn't see what I just did, but it was a little bit of it was a lot of movement. There was a lot of stuff going on in the video. So if you're listening, go over to the YouTube channel to watch that madness, and we'll see you. Catch you next week, like we do every week on the Gray Report.